I'm going to give you the exact strategy I use to be consistently profitable and become a funded futures trader. The keys to passing those evaluation accounts are drawdown, sizing your trades, trading philosophy, trade setups, and understanding what mistakes to avoid. The most important thing you need to understand in passing those evaluation accounts is understanding the drawdown amount for your account and how to size your trades based on the drawdown. You want to size in a way so that in the worst case scenario, you can take 10 to 20 losses in a row without failing the account. So this strategy is a slow and steady approach to passing the account, and this is the approach that you'll end up using with a funded account to be consistently profitable long term. So let's look at a typical 50K evaluation account. These accounts typically have a $2,500 drawdown. So you are actually going to be basing your trades off of the $2,500 drawdown, not 50K. Okay, so ideally you're going to risk no more than $250 or less per trade, potentially using $125 for higher risk setups, $250 for average setups, and then potentially sizing up $500 of risk for A+ setups. Now, how do you know how to grade the setups? In order to do this, you need to be tracking and journaling, reviewing your trades so that you know which setups have the best expected win rate and what variables in the overall market context will allow you to size up on these trades. You also want to understand what environments you need to be sizing down on and using more of the $125 risk on these things, such as choppy, poor price action, high risk environments before and after data, and we'll talk about some of these things later on in the video as well. Now that we've determined what your risk per trade should be, around $250 risk per trade, now you need to understand how to determine how many contracts you're actually going to take. So this needs to be based on the size of your stop, and all stops should always be placed based on the price structure and where the trade is invalidated, not an arbitrary number of a 2-point stop for every trade or a 4-point stop for every trade. It needs to be based on the chart. In this case, if I'm going to go long above this low here, my stop is going to be below the low, and then I'm going to be, let's say, risking 8 points. So if I'm risking 8 points and I'm trying to size based on risking $250 for this trade, I can calculate that and say at 5 points per contract on MES, I can use 6 contracts and have a stop of 8 points and still be under my 250 point risk. Now, as far as the trade management for this trade, if I enter here, so if I've got 6 contracts, be trimming 4 into the first target, 1 more into the target 2, and then trailing a runner until that gets stopped out. Now let's talk about the overall trading philosophy that it will allow you to pass these evaluation accounts and also just be consistently profitable day in, day out, week in, over months and months. Long-term profitability comes from following some overall general philosophies in trading, which is the number one thing for me is patience, waiting for a setup that you love, a high quality setup. If you don't get that setup, then you don't trade, you just sit on your hands. The main thing for me is waiting for key areas to engage. So these are going to come from the 2-hour, 4-minute chart on higher time frames. I'm going to look for areas that are key areas for me, and I'm only going to engage if price comes into those key areas, things that I see on the 2-hour and 4-hour charts. You can see this area was very important, and if price is in the middle of these two areas here, I'm not interested in taking any trades. I'm only interested if price comes into this area, or especially if price tests below and comes back above. I'm not concerned with any of the action between these key areas. That is just going to be choppy, low quality price action that's going to increase your losses. You also want to keep in mind high time frame structure in order to keep you from trading in bad price action. You need to know who is in control, buyers or sellers on higher time frames. That's going to keep you trading with the trend, avoid you taking counter trend trades. And the other thing you need to understand is what is the structure, what's the current structure that we're trading in. So if we're trading inside a consolidation structure like this, I need to understand where the edges of this structure. I want to be getting long near the edges, especially on traps below the base of the structure. Look below and fail. Where price continues to revert back above this range low, I want to be getting long in these areas. I want to be trimming into these areas. I need to understand if I'm in the middle of this area, that's a low quality area to be engaging. That's more likely to get choppy and trap me. So understand where am I at on high time frames. If I've just had a base breakout to the upside, I want to be buying dips, staying long and trailing longs. If we've just had a base base breakdown to the downside, if we're trading underneath a base after a base breakdown like this, I want to be primarily short. I want to be selling pops, and I want to be trailing shorts to the downside. Just understanding where am I at on higher time frames within higher time frame structure, that helps me be on the right side of price for the majority of the time. Now, if you want to learn more about these topics and get more education, if you want to collaborate with a group of successful traders and continue to develop your trading, click on the link in the description, join our community, and we can walk through this day by day, learn how to trade profitably in any market. Now let's look at the trade setups that I use the majority of the time. Now 95% of my entries involve price trapping below a key area and then reclaiming, catching shorts off sides, and me going long when those shorts are off sides. This gives you the benefit of some short covering as well as initiative buyers going long above this area. So you have both momentum created from short covering and from new buyers initiating longs. So you tend to have more of a momentum move. So let's look at the first one, which is a failed breakdown. So what I have here is a daily low where we put in a strong V-shaped bounce. We set a daily low. Then we came here, we flushed the low. Sellers were not able to see continuation, and price reversed, reclaiming above this area. This is an area where you want to go long. Like I said, as shorts are trapped, they're going to begin covering, and then you're going to see longs chasing, which creates a really nice momentum move. So this setup, this strategy of going long when shorts get trapped below a key area, that's 95% of my entries, right? So those have a win rate of over 80%. With this setup, you want to make sure that your stop goes below the lowest point here, below this low, and you're going to look to take profits into targets, just as we discussed earlier. Let's look at another example of a failed breakdown. This, you have more of a support shelf. You have multiple lows all in this area, but it's the same idea. If you have a really nice support shelf here and you see price flush this and unable to hold below, sellers are trapped. Now you're immediately watching for price to reverse and reclaim above this level. If sellers cannot keep this area offered, longs chasing, this is going to create a strong momentum move. And again, you want to be going long here, and you want to stay long as you are above this failed breakdown point. Now let's look at the second setup that I use most often, just a variation of the failed breakdown where you actually see sellers are able to have some continuation lower. So it's not a true failed breakdown. You did have an actual failure of this key area of demand here. But now what you're looking for is after sellers have seen this continuation, they have to keep this area offered on back tests, or you're still going to get that strong reversal to the upside if this does not stay offered. Now the difference is with this, for a reclaim, you do actually have some sellers in control below this area. So you want to wait for price to back test this area and reject. And then if price is still able to hold above this area, then you can go long, placing your stop below the structure again. With this setup, seeing some rejection here is key. You want to see some evidence that sellers are still controlling this area. So you see a rejection here, then you can go long after price is able to reject, but buyers still push price up and are able to hold above. That's your indication that buyers have now taken control back over this area, and you are going to get some of that short covering momentum higher. This is a great example of the reclaim here, where you see this area of support was broken down here. You saw sellers get continuation to the downside. You saw an attempt to reclaim here that was rejected multiple times, rejected twice. So now after you've seen two rejections, if you see that buyers are still able to push price back up, that's your indication that sellers are not able to hold this. And if you see price able to hold back above this, again, you can go long here, putting a stop below the structure, and then continue to see this momentum move higher to the upside. These are very high win rate if you are patient, and if you go long when shorts are trapped and caught offsides, you're going to get a very high win rate, high momentum entry there. Another indicator that I use to add a little bit confidence to my long entries especially is RSI hidden divergence. This is just something that gives me added conviction. You can learn more about hidden divergence in my RSI video. It's a great tool to increase your win rate and give you more conviction, allow you to size up on some of these reclaim long trades. Now let's talk about some common mistakes the traders fall into, cause them to struggle to pass some of these evaluations. The main thing, you just need to understand low quality conditions. If you're in the middle of a very choppy range, these are not the areas to engage. Avoid choppy range days like OPEX, where you tend to have very tight choppy areas where you're pinned to a specific area right ahead of major data, CPI, PPI, FOMC. These are times where you need to be sized down. You do not need to be front running data, and especially if you just had a base breakdown, do not try to catch longs immediately after breaking down a multi-day base to the downside, right? Don't try to be catching every long on the way down. Sellers are now in control. Sell pops, trail shorts, and don't get caught on low quality, low win rate environments. That's the strategy I use every day. Focus on these areas to become profitable every month and start passing those evaluations.